Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video which we will discuss seasonality. Now, we've seen a lot of seasonality reports, and I'm sure you're going to see plenty more through the end of the year, and there's kind of a expectation that markets typically generate movement in one direction or another, or we have a certain type of price action, like a reduction in volatility and trend development or increase in trend development. There are a number of seasonal effects that do occur, but I want to separate these seasonal effects into something that is useful and something that is not as useful. All right, because you will get a lot of statistics thrown at you. We want to make sure that we can actually take from these statistics and apply something that is trade-worthy. Now, one of the most statistically covered indexes or markets for seasonality effect is going to be U.S. equities, and I like to use the S&P 500 as the benchmark for that. Now, the seasonality impact that we have here, or the seasonality influences that we typically do see, are quite good, and we've discussed them a number of times in the videos. There's both a sense of performance, consistency in performance in terms of gains through December. In fact, I'll show it here. December is a strong month for the S&P 500 on average, and it also happens to be an exceptionally quiet month. All right, so we typically see positive performance in gains. This is, for us FX traders, important because it's risk on. All right, and you have a low volume situation, which is very consistent as well. That is also valuable for us as traders in the FX world, because you see low volume, low volatility readings as they come hand in hand, as we see here, that these relationships can be construed as positive risk. Now, we know how to play positive risk, and we know how to play the consistency of prevailing trends. All right, we see it in long Aussie USD, we see it in long yen crosses, we see it in short dollar typically, short yen typically. All right, these are persistent themes that we have seen. Now, this is not a guarantee. This is just a statistical relevance. All right? It's something that has happened enough times in the past that it's a higher probability of occurring this time around as well. Now, you have to be careful on how far you extend these expectations, however. I know a lot of us will look at something like this and say, oh, there is immediate relevance to, let's say, individual FX pairs or even commodities. Well, I've done a couple of measures starting with some of the benchmark FX readings, and I just wanted to show you that these don't necessarily carry clear and consistent seasonality effects themselves. All right, so let's take a look first at the dollar index. All right, because the dollar index has been exceptionally quiet as of late. It just recently broke this very tight congestion pattern. It had been held down to 70 pips. All right, that's exceptionally quiet for this benchmark. We finally have that break, but is it necessarily a consistency? Is this something standard that we see from the U.S. dollar that it drops into December? Well, I wanted to see the comparison of Decembers over the past 10 years, and I also have the average performance. Here's the performance to this point. And as you can see, there is certainly a mix in directionality. All right, bullish, bearish. There is no consistency here. There is not necessarily a seasonality effect. But what you can see is the years that the markets have been more active and those where it has been less active, which actually there is something to learn from that. You can see that 2008, 2009, and now it's starting to reduce into 2010. Those were the most active years for December performance, which typically is a little bit more quiet. I also have here a comparison of the various months for dollars performance. This is the average of January over the past year, the average February over the past 10 years, the average March. All right, so you can see that there's a comparison there, and December is typically quiet, but once again, there is not a seasonality effect that we can take away from here, because we can separate all the December for the different years, and you can see that's a separation. All right. Now that's the dollar index. Let's take a look at the euro dollar. Is there anything more straightforward? Not necessarily. All right. You can see that there is perhaps one more positive month over the past 10 years, excluding the 2013, than there were declines, but there's not necessarily a high probability scenario to draw away from this. All right. I've also looked into the Japanese yen. All right. the dollar yen, which we know has some level of seasonality to it because of Japanese producers or exporters who oftentimes have to close their currency contracts to account for their corporate financing. All right. Well, you don't necessarily see a consistent theme or a consistent seasonality effect here either. All right. So you're really breaking it down into what's working or what's not working. And I also have, this is actually says Euro USD, but it's gold. All right, gold here too does not have a consistent theme through December. All right, so I wanted to look at this just to, because I know a lot of people doubt this. They want to. I've had numerous requests for a seasonality reflect on namely these major currencies or currency pairs, as well as gold. And you can see that December is not necessarily as straightforward in terms of relevance for seasonality effect as it would be, let's say, in the S&P 500, where we do see there is some level of consistency. There's a reason there's consistency here. All right, these are investments that people take profit on. They have to account for exchange rates. While there are cross-market or cross-exchange rate investments, they don't necessarily have the bulk in exchange rates. There's oftentimes a lot of domestic investment, and those domestic investments are more likely to be booked. All right, you don't see it impact the exchange rate. So we have to separate what's useful to us and what isn't useful to us. I also took a couple other measures, once again here. This is actually the typical trading month for the Euro USD through December. All right, you can see that there have been years, this is 2008, where it's really soared. You can see that there have been years where it's dropped off quite substantially. This is 2009. All right, and you can see the black line here, 2013, and it falls generally evenly across the midline. 100 is essentially the no change level at the beginning of December. Dollar, similar circumstance, similar situation. All right, gold, similar situation, evenly distributed, and dollar yen, evenly distributed. All right, there is no statistical relevance to these seasonality runs, and knowing that, we know not to necessarily expect trends to derive from these kind of conditions. However, you can absolutely take trade considerations and bolster your probabilities by looking at those seasonality effects that do exist. And of course, that is going to be the implications of this benchmark risk trend for both volume and performance. But I'm also looking at volume because remember, this is a gauge that when you look at volume, it also happens to have a very significant impact on volatility. Orange line here is the VIX index, also considered volatility, and for most of you, as most of you know, this is also considered the fear index. All right, so when that fear index rises, you get more activity, bigger swings, bigger trades. All right, so what I also did here is to break it down into the month of December to see when volume really starts to kick in and where it starts to drop off. Now we have typically, this is not normalized, all right? You can see that this is 2013, this darker red right here is 2012, this lighter red up here is 2011. You see a trend, it's getting quieter and quieter on average, but I do want to point out that there is a spike in volume and around the 11th to the 14th day of the month, depending on when the month starts. And then there is a complete drop-off, as that is typically the Christmas holiday. All right, and that's when the U.S. capital markets close, and there is very, very little volume directly before that and in through the rest of the year. Now, knowing that there is a spike in volume here, I also want to draw your attention to a very important event that we have coming up around the same time that this volume spike occurs. All right. Remember, we have on December 18th the Fed rate decision. And as we've seen recently and as we discussed yesterday, taper speculation for a December taper has significantly increased. All right. You pair a jump in volume that is a seasonal effect with a very big ticket, highly publicized event such as this, and you have a very remarkable volatility event on your hands. So we look at price action right now. That might seem slow from the US dollar, that might seem slow from equities, which are carving out now a range on the S&P 500 between 77 or 1780 up to 1815. All right. It might seem like these markets are going to just simply fade to black into the end of the year. It's not as simple as that. There is certainly a substantial probability of a volatility event, and it comes between both a seasonality effect as well as a fundamental effect, a piece of event risk. You pair that with congestion, which is or congestion here, which is a technical influence, and you have the three necessary ingredients to establish a trade and trade expectation. All right. So this is generally a reflection of the seasonality influences. I do want you to be able to spot when seasonality is meaningful and market worthy. All right, it can actually contribute to trade expectations, like we see the volume dropping off in December for risk trends and positive performance typically in risk trends. That's something that we can apply to our trades. All right, we know that we should be looking for, in general, a opportunity to buy cheap, positive or risk-positive assets, and look for targets that are not necessarily very far away, because we know volume is low. But we can also use this in conjunction with fundamentals and technicals to recognize when there is an item, such as the FOMC rate decision, that can significantly alter trading conditions and potentially give us a bigger swing than what we typically would see. All right. So hopefully that helps clarify a number of things that I know this is a common question I get. So hopefully this illuminates it for you and actually makes it useful for you in your trading going forward. Good luck trading out there, guys. We'll do another Forex strategy video tomorrow.